Hello, and welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today I will be discussing Essential Accounting Concepts, Episode 3. The concepts in this video come from my book, Is Your Business Idea a Good Investment?, which is available on Amazon.com. Kindle version only. Go to the Amazon search bar, select books, type in my name, Jay Berman, scroll to my book to purchase, and by doing so, you support my channel and my work in business education. Thank you. So today's concepts, I'm going to finish with the income statement, which was primarily episodes 1 and 2. Discussing the net profit margin. Then I will dive into the balance sheet. In this episode, I will cover current assets, current liabilities. And just to remember, when you are calculating your balance sheet, your assets always has to equal your liabilities and owner's equity. I will discuss liabilities and owner equities in a couple more episodes. I do recommend learning either Microsoft Excel or Google Sheets so you can calculate your own spreadsheets, your own income statement, and your own balance sheets. So net profit margin is calculated by taking your net profit, which I covered in episode 2, and dividing it by revenue. What does net profit margin show you? Well, it shows you how much net profit you earn from $1 in revenue. So let's say, for example, your net profit margin is 5%. That means for every dollar you earn in revenue, your net profit is 5 cents. Typical profit margins, if you're selling goods, is anywhere from 1 to 10%, which is pretty typical for most retail operations, most retail businesses, because you have to calculate cost of goods sold, which could take up to 50% or more of your revenues. Typical profit margin for services can easily be higher than 10% or even higher, because again, you don't have to calculate cost of goods sold because services don't have cost of goods sold to calculate. In order to increase your profit margins, whether you're selling goods, services, or both, you need to increase your revenue, maybe by advertising, or decrease your expenses. So let's talk about assets. An asset is something a company owns that generates revenue. There are 2 types of assets on a balance sheet: current assets and long-term assets. In this episode, I'm going to cover current assets. In episode 4, I will cover long-term assets. Current assets are assets that convert to cash within 12 months. The most common current assets that you'll see for most small businesses. The first one, of course, would be cash. In other words, the money available in a business checking account. I highly recommend, if you're going to start your own business, that you have a separate checking account just for your business. The other one is called accounts receivable. That is money that is owed to you after you provide goods and services. For example, an invoice that has not been paid by a customer or client is still considered an accounts receivable. It's still considered revenue for income tax purposes. However, if the invoice remains unpaid for, let's say, a reasonable amount of time, let's say 30, 60, 90 days, the accounts receivable becomes a bad debt or a write-off. The other important current asset that's pretty common for most small businesses, particularly if they're selling goods, is inventory. It's the value of unsold goods. So that inventory is on, you see it on the shelves of retail stores, on hangers. All of that is considered inventory. Or if you have a small business, your inventory might be in your garage. But yeah, just understand that that's a pretty important current asset, because inventory is the bread and butter of your business, particularly if you're selling goods. So now let's talk about liabilities. A liability is anything that a company owes another person or entity. Current liabilities, also called short-term liabilities, are liabilities payable to another person, entity, payable again within 12 months. The most common current liabilities, and you can also consider them as future payments. Uh, the first one would be accounts payable, which is the unpaid invoices that you have to vendors. It could be unpaid invoices to, let's say, an accounting firm, a law firm, um, you know, any kind of service provider would be considered an accounts payable. So it's money that you owe somebody else for services that they rendered or provided for you, to you. Wages payable. So if you have employees, you have to set money aside. So that's money owed to employees. So they get a paycheck every week or every other week. Then interest payable. If you do have outstanding loans, the interest owed to banks you have to set aside. So that becomes a current liability. Taxes owed to local, state, and federal government. Not just income taxes, but you may have to pay sales taxes. So that money has to be set aside because it's a future payment. And just recognize that when these items are actually paid, then you record those items, those payables, under operating expenses on the income statement. So this is an interesting way of looking at the connection between a balance sheet and your income statement. They're connected through the payables. And again, once payables are actually paid, then they become an expense on your income statement. And there are a couple of measures for you to determine how well your company is paying its expenses. It's called the current ratio or the liquidity ratio. Liquid comes from the French word for cash. Uh, the current ratio or liquidity ratio measures whether a company has the funds to pay short-term liabilities, those current liabilities. And it's simply current assets divided by current liabilities. Your current ratio should be 1 or higher. If it's less than 1, then you're in trouble, because then your business is struggling literally to pay its bills. Another measure of liquidity is working capital, which equals current assets minus current liabilities. Again, you want your current assets to be higher than your current liabilities, which means it shows that you do have the capacity to pay your bills. If your current liabilities is higher than your current assets, then again, it shows that you're struggling to pay its bills. And there's 2 things that you can do. You're going to have to increase revenue or lower expenses, or both at the same time. And that's all I have for today. Any questions or comments, use the comment section below. Subscribe to my channel for more educational content about entrepreneurship. And I thank you for watching.